The thing that was not new, I suppose, is that retail investors can sometimes end up holding the bag here. But Spencer, when you look at SPACs, I know obviously you like them because you're doing one, but are there dangers you see in some of them out there, or is it just all good?
Well, I thought the first 95% of that description was perfect in terms of how sort of SPACs work and why they raise money. I wouldn't agree with the characterization that retail investors are left holding the bag. Look, when a company that's private goes public by merging with a SPAC, it is a newfound public company. And some of those are going to do great and some of those are going to do badly. There are lots of investment banks that will take companies public traditionally through an IPO, and some of those do great and some of those do badly. So I think the investors, retail or institutional, have to assess the quality of a public company, regardless of which process it goes public through. The reason SPACs are so popular, as you point out, is they're a risk-free way for institutional investors to get a toehold in a potential IPO. But for me, as a SPAC sponsor, what I'm interested in is, can we attract really high-quality companies to go public through a SPAC merger? And the reason that you're seeing this huge boom period of SPACs, as you mentioned, is because it's now becoming much more commonplace for high-quality companies to evaluate going public. Supernova, my SPAC, has been out for a month, and we've been having very high-quality conversations with terrific private companies. Venture capital firms and private equity firms that control the boards of a lot of these companies are very open-minded and interested in having their portfolio companies go public in this way. And there's just a real recognition that going public through a SPAC merger has a lot of advantages versus a traditional IPO. So that's why the pendulum has swung towards SPACs so quickly.
Spencer, do you think that the diligence is equal, or are there puts and takes between a more traditional process and a SPAC? I look at what's going on now with Nikola, and I wonder, would it be playing out the same way had they gone through a different process, for example?
As I said, there are plenty of busted IPOs of companies that go public through a traditional IPO and then they fail shortly after. I'm thinking of one early in my career in 2000 where I was an investment banker and I was on that IPO. The company went public, everything seemed fine, and a year later it was out of business. And there was plenty of due diligence that went into that company. So I don't think that the diligence is all that different between a SPAC IPO, or SPAC merger, I should say, and a traditional IPO. The biggest difference around diligence is the inclusion of projections. And I think this is an advantage. It's a feature, not a bug, of the SPAC process, which is to say that companies that go public through SPAC mergers, because it's a merger, not an IPO, they can issue projections at the time of that SPAC merger. And that's one of the reasons that you see a lot of high growth companies choosing a SPAC IPO path rather than a traditional IPO path, is because they want public markets to give them credit for future results, which they can preview through projections, which they can't do through a traditional IPO.
Shepard Smith here. Thanks for watching CNBC on YouTube.